All right, so here we go. The Great Debt Unwind, Wolf Richter, Wolf Street. Consumer bankruptcies jump, first since 2010, commercial bankruptcy spike. Someone explain how that sentence, any part of the sentence I just gave you, belongs in the recovery. We're in recovery. We should be past recovery, first of all. We shouldn't still be in recovery. Yet, every time I find something, the IMF, like I just said the last video, IMF says, this could hurt the global recovery, the fragile recovery. Fragile recovery. It's been 10 years. Official recovery was 2009. Christine Lagarde, head of the IMF, get a clue. Where you been? The recovery's here and done. We're way past that. We're back in normal. Or we've never been in recovery. We've been lied to. Massive amounts of debt have been created to pretend we were in recovery, only to find out we never really were. And now that they've created that massive debt, now it too has to be dealt with instead of dealing with it in 2009. So what does he got to say here? But don't blame the oil bust. Commercial bankruptcy filings from corporations to sole proprietorships spiked 28% in March from February, the largest month-to-month move in the data series of the American Bankruptcy Institute going back to 2012. They're up 8% year over year. Over the past 24 months, they soared 37% at 3,658. They're at all-time highest levels they're at the highest levels for any March since 2013. Commercial bankruptcy filings skyrocketed during the financial crisis and peaked in March 2010 at 9,004. Then they fell sharply until they reached their low point in October 2015. November 2015 was the turning point when, for the first time since March 2010, commercial bankruptcy filings rose year over year. Bankruptcy filings are highly seasonal, reaching their annual lows in December and January. Then they start to rise in the tax season, peak in March or April, and zigzag lower for the remainder of the year. The data is not seasonally or otherwise adjusted, one of the raw and unvarnished measures of how businesses are faring in the economy. Note that there is no plateauing in this chart. Since the low point in September 2015, commercial bankruptcies have soared 65%. Let me just show you this in case you want to look at it. That red spike is the mega increase in March. So follow my mouse. March 2016, bankruptcies are down. That's good. This is good, right? 2012, this is maybe there was a bit of a recovery. I mean, this is what you want to see, right? Zigzag, zigzag. But then all of a sudden, 2015 and 2016, massive increase in bankruptcies. But that's okay. It was seasonal. Back down. Everything's good. Oh my gosh, February 2017, this red line. See, when I first looked at this chart, I thought he meant this little teeny tiny red line right here, just to this point. No, he's talking about this fat red line that is now back over this level. This is now looking good. Okay. At first, they blamed the oil bust. The price of oil began to collapse in mid-2014. By 2015, worried bankers put their hands on the money spigot, and a number of companies in that sector, along with their suppliers and contractors, threw in the towel and started filing for bankruptcy protection. But now the price of oil has somewhat recovered. Banks have reopened the spigot. Wall Street is once again in the hots for the sector. New money is gushing into it, and oil and gas bankruptcy filings have abated. So now they blame brick and mortar retail, which is in terminal decline, given the shift to online sales. I have reported extensively on the distress of the larger chain stores, but brick and mortar retailers include countless smaller operations and stores that no ratings agency follows because they're too small and can't issue bonds, and many of them are even more distressed. And again, if you try to say, yeah, but Amazon's taking everything, the data, very recent data, shows retail outlets still are far outdoing what Amazon does as far as sales. So there's foot traffic, clearly. It's higher than Amazon. Businesses file for bankruptcy protection because they have too much debt. Even brick and mortar retailers with little debt can get by just fine. Their sales might decline and they might not make much money, but they can keep going. However, brick and mortar retailers with large amounts of debt are toast. This is happening to other businesses too. Piling on debt in good times puts a business on the edge of a cliff, and it doesn't take much to knock it over the cliff when adverse winds pick up. And again, borrowing's been explosive because banks have been, lending it at very low interest rates thanks to the Federal Reserve. But as you've seen, they already started raising the rates. In my last video, are they going to be able to keep doing that, or are we done? And no, they just showed their hand again. They're just lying because they can't, because the maturing debt has to be paid off at higher rates. It would kill us all. As far as borrowing more debt, we have maturing debt we have to deal with. But who else borrowed a bunch of money? All the big companies, the ones you hear about, the stocks, the shares are phenomenally high. But we find out that these companies, for the last several years, were doing massive amounts of stock buybacks from, again, that's their company, the company buying its own stock back. So if there's sellers and the stock with a bunch of sellers, stocks are going to go down. When you have more sellers than buyers, stocks go down in a company or whatever. So if you take that and you say, okay, these companies borrowed a whole bunch of money, billions, and then they used those billions, because it was almost free, almost near 0% interest rate, to buy back stocks, to keep their stock pumped up. What happens when that borrowed money they had runs out? And number two, whatever profits they've been making all these years, they're going to have to eat into that to do the same thing if they want to continue. And we have a stock market that's completely, massively overvalued everywhere you look. Recipe for disaster. So, like he's saying, you take one of these smaller companies that already borrowed to the hilt. When they'll push, they're over the edge, it's over. But I'm telling you, there's bigger companies out there that have borrowed tons of money and are essentially in the same position. And many of them doing their stock buybacks. And if they want to earn some income, there's going to be a whole lot of people who have to sell some stock. That company's going to have to, have a new stock offering? Bring some more people in? I mean, come on, you're going to have to cut people's shares down. Businesses file for bankruptcy protection because they have too much debt. Even brick and mortar retailers with little debt can get by just fine. Their sales might decline and they might not make much money, but they can keep going. However, brick and mortar retailers with large amounts of debt are toast. This is happening to other businesses too. Piling on debt in good times puts a business on the edge of a cliff, and it doesn't take much to knock it over the cliff when adverse winds pick up, so to speak. Now come the consumers, not all consumers, but those with mounting piles of debt are stagnating or declining real incomes, of which there are many. They'd been hanging on by their teeth, basically, with bankruptcy filings consistently declining since 2010. But that ended in November 2016. In December, bankruptcy filings rose 4.5% from a year earlier. In January, they rose 5.5%, 5.4 technically. It was the first time consumer bankruptcies rose back-to-back since 2010. I called it a red flag that'll be highlighted only afterwards as a turning point. In March, consumer bankruptcy filings rose 4% year over year to 77,900, the highest since March of 2015 when 79,000 filings occurred, according to American Bankruptcy Institute data. The turning point has now been confirmed. Total U.S. bankruptcy filings by consumers and businesses in March spiked 40% from February and rose 4% year over year to 81,590, the highest since March 2015. The Fed's monetary policies have purposefully encouraged businesses and consumers to borrow, but debt doesn't just go away. It accumulates. By now, an increasing number of businesses and consumers are suffocating under this debt overhang in an economy that never developed the escape velocity needed and hyped by Wall Street for years to outgrow this debt. Again, $4 of debt has to be created in the United States for $1 in GDP. Rising bankruptcies are a turning point in the credit cycle. They're not exactly a positive mile marker for the economy. The irony is thick. In all major sentiment surveys, economic confidence has soared since November. consumers, owners of small businesses, and corporate executives are riding high on their own ebullience. But the economic reality is tough for businesses and consumers struggling under the hangover from 8 years of ultra-low interest rates. I hope the model is wrong, he says. And if you want to read, he's got a link here right after that. Read Atlanta Fed GDP Now forecast spirals towards zero. Again, I link all these articles I talk about. It's just, this is it. This is the sign, which is why it is not even kind of shocking to find out we may be going to war in this country. And you guessed exactly where, of course, Middle East. Gio Chalente, I'll mention him for the millionth time because he deserves it. When they fudge the numbers as far as they can fudge them, when they fake the economy as far as they can fake it, when reality finally starts hitting home and they can't fake it anymore, they take you to war. He says that, been saying it for years, and he's spot on. I just hope with the Donald at the helm this doesn't happen, but seeing what happened in Syria the other day, not looking good. Take care.